I'm going to talk about risk, and yes, I am going to focus a bit on the insolvency side, so my apologies for that. But the focus will be on a business that is struggling financially. What that means is that a company is either running out of or has actually run out of cash. And at that stage you've then got to look at what your options are and what you can do to assist your own position. What I'd like to look at are effectively management issues and management tools. The first is cash flow. Cash, as everybody before me has alluded to, is king. And therefore number crunching. You really are going to have to carry out your own internal number crunching, and my strong recommendation is that you also include that for a 13-week period. The reason being, it does include at least one VAT quarter. The number crunching does also give you the opportunity to identify pinch points. These are also relevant for deciding how best to fund what you need going forward and where you will need your working capital. As well as identifying pinch points, don't forget, collect your own invoices, collect money in. It's just as important to get the cash in. Again, the risk of repeating ourselves, cash is king in this situation. Another management is change. Look at what you can do better. Can you forecast? Can you identify pinch points? Do you have contingency plans in place? Again, Tim and Paul have talked about the pressures and some of the headwinds. Again, they're there to be identified. Can you change with them? Your staff levels, are they correct? Production costs, are they correct? Again, we've talked about inflation. Next management revision is contracts. Are your terms and conditions up to date? Have you got the ability to increase prices, pass them on? Do you have bad debt insurance? Another issue is also around contracts, your invoices. Can they be factored? Is that a facility available to you? It does assist with cash flow if that is possible. What I'd really like to talk about is the last management issue, and that's duty management. And what we mean, and I mean by that, is your duties as a director, because these do actually change with the financial condition of your company. As you may or may not be aware, the Companies Act places a number of duties on you as a director. Exercise the powers of the company, promote the success of the company, act independently, and don't forget to exercise reasonable skill and care. That's what the Companies Act requires, but what the Companies Act doesn't is require or stipulate is a duty to ensure that the company does not trade at a loss. However, the insolvency regime does, and it does it by a roundabout method, in that if you do trade the company at a loss, and or if the company is insolvent, that does open you up to personal liability. You can find yourself being personally responsible for the losses of that company from a particular period to the onset of or the appointment of an insolvency practitioner as office holder. When is a company insolvent? There are two tests for this. The first is balance sheet, and that effectively says that your liabilities exceed your assets. The second is cash flow, and that is effectively the business can't meet its liabilities as and when they fall due. For a company to be insolvent, it only has to have one of those situations, not both. Where a company is insolvent, and this is important to you as directors, your duty is then moves from that to that of the interest of the members, the shareholders. You then owe a duty to take care to protect the interest of the body of creditors, and that becomes your primary duty, not your sole duty, but your primary duty. What you can't do is to try and avoid it, is to ask the members, the shareholders, to at some point at a later date ratify or sanction your actions which have caused damage or harm to the interests of creditors. That is not available to you. Areas where you yourselves can find yourselves personally liable. As I mentioned, it's trading whilst the company is insolvent. This is a statutory breach of your duties within the insolvency regime, and it's wrongful trading. Basically, what this means is that you and your fellow directors have allowed a company to continue trading when you knew or ought to have known that the company could not survive financially, and this has a detrimental effect on the body of creditors. Where there has been an increase in the liabilities to the creditors, you can find yourself, you and your fellow directors can find yourselves personally liable following the company entering a formal insolvency process. Another area is engaging in antecedent transactions. That's effectively a transfer of the assets for a sum substantially less than they are actually worth. Engaging in a preference, that is to say, settling a creditor's claim in preference to ahead of all of the other creditors. And last but not least, and this is fairly niche, it's actually transferring at an undervalue assets, the purpose of which is to place the asset beyond the reach of the company's creditors. That tends to be found between mates, family, but like I say, it is niche. Last but not least is a number of you may well be smaller businesses, or you've certainly drawn your income in the form of dividend. When a company is financially struggling, this is a big no-no. Dividends can only be paid from distributable profits. When is it determined that it is a no-no? It's the date when the dividend is actually paid, as opposed to the date when it is declared. So really, some of the steps that you as directors should take when you know, or it is likely that the company does have financial pressures. Take advice. Again, yes, I'm flying the HCR flag, but if it isn't HCR, go talk to your accountant, go talk to an insolvency practitioner, but do take advice. Hold regular board meetings. Hell, these can even be daily. Explore funding options. What is the company's cash position? I come back to cash flow management. Do not worsen the overall creditor position. Again, I come back to your duty is to minimize the losses to the creditors as a whole. Put systems in place to monitor payments. Only the essential, the key payments, until such time as you have come out of that particular downward curve. There is conflict, again, between the insolvency regime and the construction regime. This conflict arises where one of the parties to a contract has entered a formal insolvency process. Adjudication, smash and grab, a brilliant way of resolving issues between parties within the construction arena. However, construction adjudication only resolves one issue, or perhaps several interrelated issues, when there could be a multiple of different issues, which could or potentially result in multiple adjudications. As I say, where one party has entered a formal insolvency process, the insolvency practitioner, the insolvency regime requires an account to be taken between all an account of all of the issues between the parties. Effectively, insolvency practitioner, the office holder, will invite creditors, including yourself potentially, to prove, that is to say, set out what their claim is in the insolvency. The insolvency practitioner will then adjudicate on that. So he, she, they are obliged to apply set off, and that works on both sides, okay? They'll make a decision and thereafter communicate that to you and to all of the other unsecured creditors. If you've got an issue with that, you can apply to court, but that has to be done within 21 days. This is all part of the insolvency adjudication process. If we then look at the supply of goods and services, ipso facto clauses. Historically, Parliament has been incredibly reluctant to interfere in supply agreements between parties. But where there is a supply, where a supplier of goods and services to a company has tried to bring to an end the supply of those goods and services because of the insolvency of your client, unfortunately, that ability to do so has been severely curtailed. As of June last year. The Corporate Insolvency and Governance Act brought in provisions effectively outlawing that. What that means is where a company has, where your client, your customer has entered a formal insolvency process, you cannot cease to supply goods and services, and it must be goods and services. You cannot cease to supply these where the insolvency practitioner requires you to continue to do so. What you can't also do is you can't hold the company in the insolvency process to a ransom by insisting that the outstanding account is brought up to date. You can't change existing payment terms, such as requiring POD deposits, and you can't increase your prices. The two areas where you can wriggle out of this are where the insolvency practitioner sells the business and assets to a third party. You're not obliged to continue to supply on the term that you did with the third party. You're perfectly entitled to renegotiate new terms. But also, secondly, there is facility to apply to court to bring it to an end. But what you would have to do is show that you would suffer hardship as a consequence of continuing to supply those goods. Insolvency in numbers. Very broadly speaking, the first half of this 2021, the numbers were down on pre-pandemic. The numbers have generally been down. However, since June 2021, the numbers have increased. In corporate insolvencies within England and Wales. Nationally, construction is, as Paul alluded to, construction is leading the charge. It is now accounting for 16% of all corporate insolvencies in 2021. Tim also mentioned VAT debt. Actually, the Crown debt as at October 2021 stood at, the Crown debt as in unpaid, collected, as at October 2021 was £57.5 billion. It reached its peak in August 2020 at £72.5 billion. And again, that is uncollected debt. That can include time to pay arrangements. The point I'm driving at is, to date, HMRC has been benign, has been compliant, and understanding of commercial pressures within a business, and have looked to reach agreement on the payment of tax. At some point in the very near future, if I was a betting man, the government is going to need to review its income. And that will, I believe, cause the government to take the shackles off HMRC. HMRC is by far and away the biggest presenter of winding up petitions. So at some point, I do believe that will actually cause the economy generally to revisit how they pay their taxes. Success story, recent survey. I say a recent survey. R3 survey. R3 is the umbrella body for the restructuring insolvency industry. Recent survey in 2019 showed that the insolvency industry had been able to save 300,000 jobs. 7,200 businesses had been rescued, and a total of 1.82 billion had been repaid to its creditors. So again, hopefully it's not all doom and gloom, but again, in keeping with the theme, there are headwinds.